Hello options traders, welcome everybody. And as part of our technical analysis courses here, I wanted to introduce you to Bollinger Bands. And Bollinger Bands are interesting for a number of reasons. It's a very common indicator, very powerful indicator, but it's the first one that I will be talking about that is an upper study. If you recall in one of the previous videos, I said that technical indicators can be divided into two camps. We have upper studies and we have lower studies. Lower studies are those that reside off of your price chart. So those were things like MACD, stochastics, Williams percent R. They actually sit on a chart below your price chart. Another camp is called upper studies, and those are actually overlaid on top of your price chart, such as we're seeing here. So what is a Bollinger Band? How do you read it? And how can you use them to make better timing decisions? Well, first of all, Bollinger Bands were developed by John Bollinger in the late 80s. I say developed. Some of the textbooks and websites you see out there will say invented. I'm not going to go quite that far to say that he invented them because it's simply a statistical application. He didn't invent statistics. He didn't invent standard deviations. He just applied them to a stock chart. So really the better way to understand them is that it's just an application, and he was really the first person to apply a standard deviation in this way. Bollinger Bands are one of many what we might call band analysis or channel analysis types of indicators. There's a lot of them out there. You have Donchian channels, you've got Keltner channels, moving average envelopes. There's lots of different types of channel indicators, but all of them share one thing in common, and that is that they are designed to encompass most of the price action. In other words, we want to look at our chart and say, where will most of the prices fall most of the time? With Bollinger Bands, they consist of three lines. There is a center line that is a moving average of prices. And then you'll have two other lines. There's an upper and a lower, and those are simply two standard deviations away from that center line or from that moving average. So if you look at the chart down here below, this line right here in blue that sits right between the two bands, that is our center line. And it's just a regular moving average of those prices. But then you'll see that there is a variation or an envelope around that center line. We have an upper line up here that's two standard deviations on the high side of that blue line. And then we have a lower band down here that is two standard deviations below that center line. So now the question becomes, what in the world is a standard deviation? Well, a standard deviation is simply a statistical calculation, and it gives us some very important information. So for example, if we throw a pair of dice and we add up the two face-up sides, and we were to do this hundreds of times and calculate the percentage of times that we got, let's say 2 or 7 or 12, and we looked at that on a chart, this is what we would get. It would form a bell curve. And if you look right here, you'll see in the center, that's the average, 7 is the most common occurrence. Is it the only occurrence? Of course not. If our dice total 2, we get 2 ones. That's the smallest number we could get. Of course, they could both show 6s, in which case we would have a total of 12. But those are fairly rare. Most of the time you're going to add up to 7. But the point that I want you to see right now is that you would get a bell-shaped curve. We can also get this in professional sports. Let's take a look at basketball. If we look at the NBA points scored by the home team, look what we get. Another type of a bell curve. Well, lots of random data follow a bell curve, and stock prices are no exception. Here's a chart of eBay, and you can see that if we look at the daily returns, that's the percentage up or down per day, 0 is the average. But it's not the only number. There's variation or a spread around that average. That bell curve can get wide, and it's the width of the bell curve that we're trying to measure by the standard deviation. To understand the concept better, let's take a look at two curves. I've got one in yellow and one in red. The yellow curve and the red curve actually share the same center right here. In other words, they have the same average. However, the yellow curve is very tall and skinny. And if we were to actually measure it, we would find out that it has a very small or a very low standard deviation. And that simply means that the variation around that center line isn't all that great. The numbers are fairly tightly knit to each other. On the other hand, if we had some data that might exhibit a high standard deviation, it would look more like this in red. And that's just saying, even though they both have the same average in this example, the high standard deviation data exhibits a lot more variation around that. So what we're trying to measure with the standard deviation is how do we describe the width or the spread of the numbers in this bell curve. The reason this is important is that it gives us tremendous insights into what we can expect from future numbers. And for those of you who have had statistics will certainly remember the empirical rule. And it's just a generalized categorization of all bell curves. And what it says is that 68% of your observations, regardless of the bell curve, 68% of them will fall within one standard deviation. And one standard deviation down here is this area in red. On the other hand, 95% of your data will fall within two standard deviations. And so that would be the area down here of red plus blue. And then finally, almost all, or about 99.7% of all of your data will fall within three standard deviations, which means it will most likely fall somewhere in all of these three areas, the red, blue, and the yellow. Now, just for a side note, don't think that three standard deviations is the limit. It goes beyond that. There's a fourth and a fifth and a tenth and so on. The problem is that the probabilities of getting anything out in those areas is so small it's almost not even worth talking about. So for the most part, three standard deviations tells us everything that's going to happen. So to clarify it, let's take a look at an example. Let's say that we flipped a coin 100 times. Well, you would expect to get 50 heads. And in fact, if you did this thousands of times, you would find that that is in fact the average. However, we could also calculate the standard deviation, and if we did, we would find that it comes up to 5. I'm not going to go through the calculation here. It's not really all that difficult, but the number would be 5. So what does that tell us? Well, go back to your empirical rule. What it tells us is that 68% of the time, you will be plus and minus 5 of that average. So if the average is 50, that means we'd tend to get maybe up to 55 on the high side and maybe down to 45 on the low side 68% of the time. If I wanted to get a little bit more confidence in what I could expect, I could look at two standard deviations. If one standard deviation is 5, two standard deviations is 10. And therefore I could subtract 10 and add 10 to that average of 50. And I would therefore know, based on the empirical rule, that 95% of the time I'm going to end up with somewhere between 40 and 60 heads. Now, if I want to have a large amount of confidence, I could go out three standard deviations, which would be 15. Subtract 15, add 15 to that average of 50, and I would know that nearly 100% of the time, 99.7% to be exact, you're going to get somewhere between 35 and 65 heads if you flip the coin 100 times. If we actually looked at the distribution of a coin tossed 100 times, this is what it would look like. And as we'd expect, right here in the center is our average of 50. That's right where the center of that bell curve lines up. But take a look at the high side, right there, pointing right to 65. And that is taking 50 plus 3 standard deviations. 50 plus 15 gives us 65. And you can see it's pretty rare that it gets above this level. Conversely, if we take 50 minus 3 standard deviations, or minus 15, we get 35. And that's right where that's pointing, right there. About 35 seems to be about the low. Is it possible we can get out in this range or fall down in this range? Of course, it's just not going to happen very often. 99.7% of the time, you're going to be somewhere between 35 and 65. So the important thing to know about a standard deviation is that we can figure out where most of the prices will occur most of the time. So let's take a look at the Bollinger Band rules for the setup. First of all, you should use a simple moving average. Do not use the exponential. Why? Because when we calculate the standard deviation, we are using simple moving averages, and we want to keep consistency in the data. Now, there are exponential Bollinger Bands, but that's going to get a little bit more complicated. For right now, I'd rather see you use a standard Bollinger Band. You will use 2 standard deviations for 20 periods. This is the default. 20 periods. Keep in mind, which I've talked about in previous videos, that when we say periods, what we're really saying is that it's the unit of time. If you're looking at a minute chart, it's 20 minutes. Day chart is 20 days, and so on. So anytime you're using a 20-period chart, you should use 2 standard deviations. However, John Bollinger suggests that if you're going to shorten that a little bit to, let's say, 10 periods, you should tighten up the standard deviation range to about 1.9. On the other hand, if you want to widen it out to, let's say, 50 periods, you should use 2.1 standard deviations. So there's a little bit of wiggle room, but for the most part, you want to just stick with 20 periods and 2 standard deviations. Let's take a look at how we would apply Bollinger Bands to a chart. I'm going to use Amazon, and we're going to click right up here where it says Studies, and there is Bollinger Bands. Now, if you're not seeing it on your platform, remember you have to click down here to All Studies, and you'll see a huge list of different types of technical indicators. But once you choose Bollinger Bands, there are the defaults. Default is 20 periods, standard deviation is 2. Type of moving average, simple. For this video, I'm going to make the upper band, let's make it red, we'll make the lower band red as well. And I'm going to give the center, let's give it this blue color here so we can make it stand out a bit. Choose Save, and there are the Bollinger Bands. So one thing to notice here is you're going to get kind of some odd looking shapes. You get some areas where the bands are fairly close together, and then you get some areas where they widen out. You'll also get some really strange ones where you get these almost circular patterns out here. What's causing this? Well, remember, the standard deviation is measuring the variation in the data. So if you have a period of time, like back in here, where the size of the candles are fairly low, there's not any large gaps up or down, then the bands will tend to tighten. They'll contract. On the other hand, if you get a period like this where you see this big gap up here on this candle, that's going to throw your standard deviation because you get this huge jump in numbers. And that's what's causing this very odd looking rounded shape right here. So whenever you see that in the chart, you can tell that something big happened, either a big up day or a big down day. But then if you also have periods where you came from a kind of a quiet period, and then you started getting some maybe little gaps up and down, but you've also got very large candles in here, a lot of variation intraday, you will see that the bands will widen. Now that you understand the basics of Bollinger Bands, let's take a look at some Bollinger Band rules. First of all, as a very basic use, you can use them to provide relative high and low points. Remember, 2 standard deviations encompasses 95% of all of the data, all of the price action. So therefore, if you ever see your prices get outside of these bands, there's a very good chance you're going to see it fall back inside. However, understand that whenever a price touches the band from within inside, whether it's low moving up and it just touches the upper band, or whether it's moving from the center to that lower band and it just touches, that's what we call a band tag or a touch. It is not necessarily a reversal sign. Like most of your technical indicators, we want to see it swing from the high side down or from the low side up. And that's a big mistake that a lot of new traders make. They'll see the price touch, let's say, from the upper band, and then they immediately say it's a reversal, and that's not true. In fact, prices can do what's called riding or walking the band. So that price you'll see, we'll look at some examples here in a moment, can actually ride up along that band for long periods of time. So sometimes just because prices hit that upper band, it can actually be a sign of strength. And the longer it rides it, it's usually a bigger sign of strength, not weakness. Conversely, if it happens to ride that band to the downside, that lower band, that usually is a sign of continued weakness. However, closes outside the band, even though we might expect them to revert back to the center, initially mean that it's a continuation signal. Remember, highs can go higher, lows can go lower. So just because a candle happens to poke up outside the upper band on a particular day, or 2 or 3 or 4, doesn't necessarily mean it's going to reverse. It's usually a sign of a continuation. However, when a stock price does revert, it tends to travel all the way to the opposite band. All right, so here we are back on Amazon, and now you can see, here's a very good example of prices riding or walking the band. So just because this candle happened to poke its head up above that upper band doesn't mean it's necessarily going to revert. Again, that's a big mistake that a lot of new traders make. This is usually a sign of strength and continuation. But once we do get a break down here, there is a tendency for it to go all the way to the next band. Here the candle didn't actually hit there, at least the body, but you can see that the shadow down here did actually touch. Once we reversed, came all the way back up to the upper band. Once it reversed up here, it came all the way back down to the lower band. But again, you can see that most of the price action stays inside the bands. Here's another good example. Look at this big gap up, this big red candle right here. Again, you have to think about mean reversion here. Yes, it's initially a sign of strength, but when it failed the next day, this should tell you that we're probably going to see it revert back towards the mean, in which case it did. So it's just kind of a basic recap. The thing that you want to look at least when you're starting out, is to realize that most of your stock prices are going to stay between the two bands. That's really the essence of it. Whenever we get towards the top, you need to start thinking, this is looking a little bit high, a little bit more like an overbought condition. When you're down here, it tends to be a little bit more on the oversold condition, more into at least for long-term buying, a good entry point. If we are getting a reversal from one band, good chance we're going to come all the way back to the other band and touch. So in this case, just because you're coming off the bottom, I wouldn't be, let's say, selling calls against a long position. Maybe trying to offset some of your theta. Wouldn't be doing it down at this level. Much rather be doing it up here. There's another neat little trick we can do that's called a double band or a double Bollinger Band. And what I'm going to do is come back up to my studies and I'm going to choose Bollinger Bands. But now I'm going to make it one standard deviation. And let's just make the center part, let's say, red right here. And now we get a little different picture. Inside of this middle band here, this red band, is plus and minus 1 standard deviation. Inside the blue band here is plus and minus 2. So what it can help you do is to notice that anytime you are above 1 but below 2, such as in this blue area up here, that's a sign of strength. You're more than 1 standard deviation up, and you should stay in the position until it breaks. However, once you break the 1 standard deviation band, that might be a time to change directions, hedge it somehow, but at least it would show you that maybe that strength is starting to break. On the flip side, once that candle breaks the bottom 1 standard deviation band, there's a good chance you're going to come all the way back down to the 2nd standard deviation. So this would be kind of signs of weakness in this lower blue band, signs of strength in this upper. So one thing you can do to help you keep on those trends longer term, which all of you know that I'm a big fan of that, you've got to stay on these trends much longer. That's where the money is. And by using double Bollinger Bands, that can help you. Anytime these prices are up in this upper band here, above 1 standard deviation and below 2, stay in it. And see it up here too. And then once that candle breaks through here, I generally look for maybe 50 to 75% break. Good chance we're going to be coming back into this 1 standard deviation band. So that's a double Bollinger Band, just a special application of Bollinger Bands. And I hope that helps everybody to understand the basics of Bollinger Bands. It is our first upper study. We'll look at many more. But again, put these on your platforms, use them in conjunction with your lower studies. Post some questions on here on the site, and I hope that helps, but please let me know what you think, and we'll talk about some more upper studies soon. If you'd like to know more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com. We'd also like to invite you to join the free Facebook trading group, Options A to Z. You get lots of great market commentary, free videos. We'd love to have you join.